Hello there, Drew Meredith. How you going?
Incredible.
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 You shouldn't be, because according to if I just bring up my latest numbers here on
Everything happening.
the portfolio, I believe you've slipped from number 1 to number 3. Is that correct?
I'm not privy to the day-to-day movements, nor would I be looking at the day-to-day movements because you're in a short to medium term portfolio. And what happens on a day-to-day basis doesn't worry me too much.
Get out of it. So Drew's actually losing.
It would if you were twice leveraged into the US share market.
Well, that's why we get G-Gus in the
You were losing yesterday.
So just to bring it up for everyone on the screen in front of you, if you're watching, for everyone that's listening, the Dizzy Rascals portfolio is up 2.98% according to the Navexa scoreboard. Use Navexa to track your portfolio. It is what we use for the Rask portfolios, and it is a great tool, and you can integrate with your brokerage account.
All from one stock.
Shout out to Navexa. So Dizzy Rascals, have a guess who's saving the day for the community?
The consultant. The consultants always win.
Consultant Kev Toohey. If people don't remember, when we chose the 3 portfolios of $10,000, these fake portfolios, Kev Toohey, a consultant with Atchison Consultants, gave us a tip. He said, I don't know about recommendations, but I'll give you what I'm invested in. And something about not BlackRock, something about private equity being something or other. And he gave us KKR. It is up in total return terms, 12%. So that's the highest performer. But Kev is being let down, as is the community, by whoever picked Vulcan, which is down 13% already. We're only 30 days in.
I know Kev. I believe Kev's doing well at a KKR, so I think he's booked a trip to Europe or something already.
Oh wow, Kev's just taking his gains. As for my portfolio, which is aptly named "This Is the Best One" by our producer Monique,
very close.
I've got a bit of asymmetry, as they would say, Drew. In ResMed, I'm up 10% there.
Yeah.
I've got G-Gus though, so that's a leveraged ETF on the US stock market. That's doing pretty well. How about in the everything portfolio, which is the Honourable Drew Meredith's portfolio? Talk us through this, Drew. There's a big red arrow here. What's this?
I mean, it was a bold call going into the tech sector right before earnings season, for better or worse. But everything's going reasonably well, apart from Tesla and more so NVIDIA. But I think I'm pretty comfortable. And we're going to go into DeepSeek probably today as well, which was the driver of his performance. It dropped 17%. Lost $1 trillion Australian dollars in value. That's not profit, just in value, in one session. I mean, when you consider it's worth $3 trillion US, yeah, almost 600 billion. I mean, if you want to say 600 million, but it's 600 billion in value. There was a good stat that it was like, did you see that today? I think it was, they used to make $100 million in profit a year. Now they make $100 million profit a day. Something like that.
Wow, I didn't know that. That's big.
Yeah. I believe it's correct. Probably same as my baby drill quote last week. Just make sure you update me if I'm wrong, and feel free to comment. We love comments.
Yeah.
Spotify, Apple, always do a 5-star review, but comment as negatively as you like.
Yeah. Especially on Drew's golf game, because we copped a bit of flack, shall we say, on the old YouTube comments last week. We did talk about golf for all of 3 minutes, which was too long.
Yeah. I mean, it felt too long when we were talking about it.
So this week we do have a lot of questions that have been sent through, which is absolutely wonderful. We had a gentleman who almost choked at his croissant last week when he heard his own question being read out. So hopefully, for everyone that gets their question on the show today, there are some crackers about bonds. We've got some stuff here about lump sum investing versus DCA, an ETF that someone thinks we've never heard of. And then the Roman debt collector has written in about the big man being back in office and what that means for different things.
I've been in the office for weeks.
The big man has been in the office for a long time, but I think he's referring to a different big man, being Donald Trump. Not to be confused with Donald Tusk, who's the Polish president or something. Shout out to Donald Tusk as well. So, Drew, let's start with the big news of the week, which came from it's the tech sector. And the reason that this was quite interesting, I'm actually going to do a bit more digging into it. I just haven't had the time because I'm in Sydney at the moment. But DeepSeek is a really fascinating development for anyone that's invested in US tech in particular, because basically they've come out and they've got a bunch of tables on their website that no one really understands that says they're as good or better than ChatGPT at certain things, and OpenAI, which is the big Microsoft-backed entity. So naturally, when the US supremacy in tech is challenged, investors get really spooked, particularly when it has to do with China. What do you put this down to? Like, do you think about it?
I feel like everyone was just waiting for a reason to sell. Like NVIDIA, Apple, all these stocks have done so well this year. Just even the slightest bit of negative news, they just took the opportunity to take profits. Now, most people, apart from me, aren't buying NVIDIA fresh, or a lot of NVIDIA fresh. So most have been holders, which means they any sign of stress or an opportunity, they'd taken the option to sell, and then a day later they were buying it back. I think it dropped 17 in one day and then was up 8 or 9% the day after. Still off that 8 to 10%, as you can see from my portfolio. But it does feel like, because valuations are historically high, and we can go in another conversation about that, any kind of negative news will immediately impact the market sentiment, but it won't necessarily be sustained. I mean, we had Apple reporting, Microsoft reporting overnight, and there was an interesting comment in there as well. So DeepSeek is basically an extent, even on their website, they're rivaling ChatGPT. But did you see Microsoft's report this morning?
No, I haven't had a chance to read through it. Well,
so DeepSeek's claim was that they only spent $6 million versus the billions that went into OpenAI to build their model, and used far less chips. So they needed less of NVIDIA's chips, which means NVIDIA won't be needed as much, and all the flow on that. That's why it dropped so significantly. But then in Microsoft's announcement in their earnings call, they mentioned, I don't think this is an accusation yet, but they talked about the fact that there had been some inappropriate access to OpenAI's data. I'm not sure. Yeah, there's headlines on Bloomberg, and that potentially someone was collecting all the data to then build their own model out of it. Yeah, there you go.
Let's have a look. Yeah, OpenAI says Chinese rivals using its work for their AI apps. I mean,
open API, that's a problem. So
no duh. Like
how can you build it on $6 million when it took someone else billions? So I think, and all these things, the initial reaction, and it's probably the nature of newer investors as well. The initial reaction is negative. Oh my God, everything's going to change. But then calm and kind of common sense starts to come into it. And regardless, there's always going to be competitors in this space, but you have to gain enough users and have the scale and usability to actually win. Very few will win.
The crazy thing is, like, this sort of stuff has been happening for a very long time, right? Like, there's a very meaningful difference, let's say, between Chinese intellectual property rights and West intellectual property rights. So
navigating that fine line.
This is just probably the most visceral example for people right now. And so, I mean, this would probably not surprise a lot of people. When I first heard the claim, I think it was 10 million Aussie is what they estimated it was worth. I thought that it was very interesting how this was brought out and when it was brought out, to be honest. And I feel like, for me personally, the future of probably AI, and in particular, as we kind of march towards, AGI or something like that, it's going to be so hard to be incrementally better than the other model that's kind of ripped you off or whatever.
Yeah.
But it won't really matter. It's just whoever gets there first kind of thing is the one that's going to be the most valuable, and it's going to take lion's share.
And you get the users, yeah.
Yeah, exactly.
And then you get more data, the more people using it. I think DeepSeek had to cut users, or had to stop accepting users because there were too many people on it.
Yeah, right. But like you could use Meta's platform. Meta's platform's fully open, right? You can go. I don't even think you need to log into Facebook or anything like that to use Llama and jump into that. I was using that a few months ago for some different projects that I was trying to build, and effectively, it's very restricted compared to OpenAI, which is by nature open and more accessible across the internet. So for folks that don't know, a lot of the models have very strong constraints around them. Like you can't, for example, you can in a roundabout way, but you can't always use one of these models to be like, hey, go and copy the AFR website and tell me which are the best articles or something like that. Like there'll be constraints around what data you can feed in, how you can pull data, and those types of things.
Yeah.
And so it's kind of like AI safety. That's basically what we all talk about in this world. And yeah, it's not as sinister as people think, I think.
And it's all like it's always been. It's all about data and there's always going to be biases that come into these platforms as well in some way or another.
Yeah.
So, and you've seen that with all over Twitter and all the publications this week too.
Yeah, well, if you look at XAI in particular, like that's the model that's built by Elon Musk's company. That's natively embedded in Twitter these days. And I remember when that first launched, there was a joke from Sam Altman, the founder of OpenAI, that basically said, he effectively said, in my words, well, look, someone used our AI to build their own AI. But yeah, Bloomberg also has its own engine as well, for people that don't know. If you think about data, to your point, Drew, imagine like an AI engine that sits on top of the most rich data set in the world, which is Bloomberg.
Yeah.
That's effectively what's being built and rolled out now from Bloomberg. So it's interesting, if you go into the ChatGPT marketplace, one of the most popular models that people are training in the world is actually an AI model that analyzes stocks.
Yeah.
And you can get that for free, and everyone that uses the model therefore trains it more and more and more.
Should have put our portfolios in there.
Well, they probably would have come up with an error being like, you can't do this. AI safety says don't invest in these things. We should actually mention that the $10,000 portfolio challenge is not our real portfolios. It's not something that we recommend. It's just a bit of fun on the show, and you can check in every week, every Saturday morning here on the Australian Investors Podcast. But that's really interesting, because I just came from chatting with the Global X team, who specialize in thematic ETFs, commodity ETFs, and in particular, they have this big focus on AI and different ways of investing in AI, in particular this year. And I was chatting to the team over there just 45 minutes ago about how there's this kind of secondary layer in the stock market of companies that are about to benefit in a massive way from AI. Because, like, for example, let's take this DeepSeek thing. If OpenAI was the original engine that was really hard to train and took a lot of care and intelligence to build, and then DeepSeek just go and rips it off, effectively what that means is then any Chinese tech company could effectively plug into DeepSeek and use that to build their technology system, right? But if you think about it, the next layer of companies are kind of like tech companies, maybe even businesses like yours and mine, Drew, that are like in that space where we don't have the capability, but we don't need the capability anymore. We can just use what's already been built and do more of what we are good at. And I think that's the next layer. And I think people that are looking at like small cap ETFs, people that are looking at like the next layer of tech stocks, are just FANG still works, obviously, great call, my friend. But the next layer down, I think those kind of technology companies, the industrial companies that would traditionally have to pay $5 billion a year, perhaps, to get a software engineering team that could deliver in the healthcare system or something like that, they won't need to anymore. They could maybe spend 500 million rather than 5 billion.
Applying AI and integrating it properly.
Yeah, they might have this big line in their P&L and their profit and loss that says costs of OpenAI, or money we're giving to Microsoft as the world tax. But the reality is they'll get a better product by just leveraging what someone else has built. It's kind of like no one really rebuilt the internet. They just used what was already there. And once that kind of takes a hold, I think we'll see some really fantastic things for investors in that mid-market.
And I think even for the big companies are still there. I was looking at the Microsoft result this morning, and their biggest problem is the ability to add more data centers. There's so much cloud and AI that the data centers are the bottleneck for them. And there's something like in the earnings call, they said they have like $300 billion worth of commercial contracts that they haven't been able to execute on, that they have to execute on within the next 12 months. another $300 billion in revenue. But there's not enough computing power. There's not enough. And this is why AI, this is why thematics, when well-timed and invested in it, as we've said, appropriately, not just chucked in your portfolio, the story just is stronger than ever. It's not going anywhere. And yeah, their revenue slowed down. It only grew 12% this year, but pretty much any company in the world would be happy with 12% quarterly revenue growth.
When in my investor letter that I gave out to our Rask investors not too long ago, I actually shared something about the future of AI spending, and in particular, I mean, you go and you're researching a company or you're researching a theme, and you pull up some industry report that you have to pay for, or it looks fancy or something. It's really just some bloke who sounds like he knows what he's talking about and just points in the sky and goes, "Where do you want it to go?" But basically, with AI, the consensus amongst all the researchers is that by the year 2030, we could be spending anywhere between $800 billion and $1 trillion a year. That's like per year, AI infrastructure and related like enablement.
Yeah.
And you think about that, you think about who has to drive that, where they're going to spend that money, who is going to benefit from that. Like, obviously, they're not just throwing money into the wind, they're actually spending it because they're going to get a return. And I just think that that's, if it's big, if true, and even if it's half right, the transition to the cloud computing for people that are unfamiliar, like the transition of advertising to digital advertising away from just being on the radio or TV or on the side of a tram. It was estimated at one point that whole transition of like advertising plus cloud computing could be $1 trillion.
Yeah.
We're saying this one pocket of technology is worth that as well. And if you look at all the great investors over the past 20 years, a lot of them adopted that cloud computing move early. Like, hey, Microsoft, you used to buy a CD, now you pay a subscription and you pay more and more every year. Well, what are the ways that you can benefit from that AI shift? I think that's really exciting for investors right now, both stock pickers and ETF investors. I think it's just, and it's I'm not going to say everything's a gold mine, but there is a lot going on here that I think people are underestimating.
Yeah, and it can like scale your business incredibly quickly. The challenge has always been adding new people, training new people, and then your systems and bottlenecks popping up. And we've got it in our business. I'm sure you have it in yours too.
Yeah.
If you're able to not replace people with AI, but utilize AI to allow greater scalability and tailoring, then it can be incredible. And it's going to be the difference between businesses that do well, particularly on bigger businesses, and businesses that basically disappear.
Yeah.
They'll get gobbled up by the big ones.
Yeah, absolutely. So I think, like, I don't know, neither of us know what the stock market's going to do over the next year. We can't even pick bloody interest rates from one year to the next. Let's be honest.
Oh, well, maybe we can. We'll find out shortly.
Well, and remember, guys, if Drew's bold, big, hairy, audacious bet on interest rates doesn't come true by the end of March, was it?
Or Easter? Did we say Easter?
Easter. If interest rates are not cut, he owes us all a copy of his book, The Golden Years.
Audible.
Well, actually, it's funny you mentioned that because we did have a question. I don't know where I've got it. I've lost it now. I think it was sent a while ago, actually. I have no eyes. Wrote in, shouldn't laugh about that. They may not have any eyes. And said, when is Drew's book coming to Audible?
I actually just emailed the publisher before, when we were preparing for having a chat. Preparing off air, I asked the publisher, can we record Audible? And then we have to find a suitable voiceover. And I know I have no eyes, suggested I could do it, but I hate the sound of my own voice. So we're going to have to see how that goes.
Pick someone with like a really good radio voice.
Yeah.
Like it just, yeah. Or even, I don't know, you don't have to have the same voice.
Sounds good when sped up, like be able to talk really quickly and read the book really quickly just in case people sped up.
Yeah. That's perfect. They'll get it done real quick. They'll be really satisfied with how quick they went through the book.
Or I can slow it down.
In other news, interest rates will probably be cut now. I'll come back to the probability, but inflation data, good. RBA.
Amazing from my perspective. I got 17 boxes of books under my desk. They're actually holding up my desk at the moment. I have not opened the boxes, so I'm that confident. I believe there's a meeting next week, but these days, the RBA's just changed all their meeting dates, so who knows when they are now. It used to be the first Tuesday of the month, but who knows?
What do the books have to do with interest rates?
Free books.
Oh, free books. I gotcha. This is some sort of Bush analysis of how interest rates work.
Bush League.
Uh,
Inflation dropped 2.4, and I was happy enough to go find some quotes, and the views are mixed. So Paul blocks them from HSBC. While the risk of an earlier move has increased, we see it as a close call rather than a done deal. So thumbs down to Paul. Vanguard has held firm that its Reserve Bank will not start reducing rates until their second quarter. We remain cautious. RBC,
What else do you expect Vanguard to say?
today's data will have given the bank greater confidence and expect a rate cut earlier than the second quarter. So
Wait, was that from Vanguard or was that for someone else?
that was RBC. Royal Bank.
Oh, okay. Vanguard's naturally conservative, which makes sense.
Yeah, they don't want to view on anything.
RBC, I don't know.
RBC. Well, most major banks have said February. And I think it would be incredibly helpful we know it would be incredibly helpful for people with debt, properties, and consumers generally, and the economy. The risk is how much an initial rate cut would boost spending, and I don't think it would be overly significant.
Yeah. What do you think? I'm going to give you a bit of trivia. Based on yesterday's data, because I don't have the updated data, what probability?
67% probability.
So you're saying that the market is pricing in 67% chance that interest rates will be cut at the next meeting?
Yeah.
Well, I'm going to show you a chart here. And for anyone that's watching, you'll see it, but I'll walk you through it if you're listening.
Even better.
It is 95% that they will decrease. That's according to the latest market rates, interest rate expectations. So basically, they do some sort of implied yield curve, and they kind of tally it all up. The ASX is doing this, by the way.
When was the last time it was 95% though?
I don't know. They could all be wrong, let's be honest. But it's gone from, on the 16th of January, it was a 73% probability according to markets. Now, the probability is 95%. And this has obviously jumped from 84 up to 95 in basically one day because of the inflation data.
Wouldn't surprise me if they cut by 50.
You've always said that. You've always said that you suspect that the market would go heavy or go home.
And look at our currency. I think we've had that many questions over the last 12 months, people worrying about the currency rallying. And I think it almost got back to 70 cents. Now it's like 62 cents, 62 US cents.
I had a bet with my father-in-law that the Aussie dollar would get back to 70 cents before we got to Rome. And it actually went down. So I ended up having to buy him pizza. It was a pretty good pizza, let's be honest. And I enjoyed some of it too. So it wasn't...
No more Europe travel.
No more Europe travel. Not at these rates. The Australians are taking our pesos and going to overseas and we're not getting much. The international man of mystery, Pete Wargen, over on our Australian property podcast, he's in a different country every other episode. And he was saying that you just don't get much these days. And if you were traveling, ouch, that would hurt.
I'll think about the $17 coffee.
Yeah. Yeah. Speaking of outrage about prices, Drew, I'm here in a hotel in Sydney. If you can't tell behind me, shout out to the Fullerton.
I thought it was those virtual backgrounds.
Yeah, just with a cruddy light switch behind me. And I got charged. I didn't realize this until I hit submit. I got in late last night and I got this overpriced thing off the menu for the room service. They charged me $10 for a delivery fee.
Okay, Uber.
I'm on the 7th floor. It's not that high up. Like you think you could take the steps for less than $10. So I couldn't believe it. I didn't see it until after I'd submitted and I was like, oh my gosh, what does this world come to? Anyway, enough golf talk. Let's get back to the questions at hand.
We'll go sailing talk.
Yeah, true. We could talk about anything. Travis Fimmel on the beach. Roman Debt Collector did write an interesting question in, and I'm going to combine this question, Drew, with two chimps in a trench coat. So Roman Debt Collector wrote in and said, with the big man back in office, obviously he meant Drew, just know that America will spend. Interested in utilizing this with America's ever-growing debt, thinking that maybe credit risk may be being added to US bonds. But I'm eternally confused about how to best utilize bonds and when they go up or down in value/income, assuming he doesn't get impeached. Was thinking that at least a 5-year time frame, but also know that the Fed is likely to continue cutting. All of this gets a bit messy in my head. Is there a simple explanation for how to best play this idea in general, of course? And there was another question that came from two chimps in a trench coat. I actually verified that's their name on their birth certificate. And they said, I'm sure this has been answered a gazillion times before, but can you please generally explain the strategy behind investing in bonds and how this relates to equities? I find myself dollar cost averaging into bonds like IAF and VBND so that these represent approximately 15% of the entire portfolio, which I'm comfortable with given my age and risk appetite. I get they are defensive and will minimize loss in a downturn environment when equities get punished. But I want to use this portfolio allocation as a tool to capitalize on large market corrections. In a perfect world, I would like my bonds to increase in value as my equity portfolio holdings get smashed, at which time I would rebalance all of the fixed interest of my portfolio into the shares at hopefully cheaper prices. Only thing is, I have no idea of how this will work, i.e., will my bonds increase in value as equities are falling? Help, please. Before we answer Roman Debt Collector and two chimps in a trench coats questions, I will always suggest that you speak to a licensed and trusted financial planner like, say, Drew here, because we can only speak generally on this podcast. We don't know your needs, goals, objectives. So please speak to a financial advisor before you act on the information. Secondly, we have no idea who you are. You could be two chimps in a trench coat, and that could actually be your birth certificate name, but I don't know. And neither does Drew. And that's important to understand because, again, we don't know your circumstances. And if we do talk about anything on this show, like an ETF or a super fund, go and read the PDS. That's the product disclosure statement at the absolute minimum. We don't talk about things on this show so you go and act on the information. We do it so that we maybe can help guide you towards better decision making of your own or with a professional. So with that said, Drew, do bonds actually go the other way when shares go down?
Yeah, I mean, there's two really good questions here. One of them is a high level question, and one of them is a detail of product question. I'll start, I think, starting with the high level question, and I know you'll chime in too when I get too far off track. But what you're talking about, what Twin Chimps in a Trench Coat is talking about, is the concept of asset allocation and diversification. And this is what you want when you're investing for retirement or passive income. You want consistency, and you want, we know that shares will provide the best returns over the very long term. They've historically done it, but they don't do it every single year. And there could be years or decades where they go sideways. There's also years when they fall significantly. So what you want in a retirement portfolio or in any portfolio that you want to use to generate income or support your lifestyle is resilience against major shocks. And we know, and there's different ways to do that. There's fixed income and bonds, like we're talking about. There's other alternative assets, and there's more diversification. Diversifying away from technology, all those sort of things. There is no set rule that suggests, and there's evidence that shows that bonds perform better when share markets are falling. But the biggest driver of bond valuations and bond returns is interest rates and expectations for interest rates. So what typically happens, and this is what we've seen in every crisis, I missed the .com, but every crisis since, is that when the recession or when the share market finally gets hit in the GFC, in the pandemic, in the unwinding of the Fed balance sheet, I think in 2012, is that interest rates get cut almost immediately. We saw it when the GFC hit. The interest rates were cut to try and support the economy, to try and support the banking sector, and reduce the risk of defaults. And in the pandemic, interest rates were cut to essentially keep the economy moving. And when interest rates are cut, that means when you're investing in IAF and VBND, you're investing primarily in government bonds, and those bonds are fixed rate bonds. So you've got a guaranteed interest rate from those. So if the market or the prevailing interest rate falls, the interest rate you're getting is better, and the value of those bonds naturally increases. You get there's two to three reasons why you invest in fixed income. One is the income they produce in the form of an interest payment, and the second is a diversification benefit, that they don't necessarily act perfectly non-correlated or the opposite to equities, but in environments that are associated with economic and market volatility, they tend to outperform. Similar to gold, you'd say gold is a non-correlated asset, but at different times it is correlated with bonds. It is correlated with equity markets.
Yeah, that's well said, Drew.
I wasn't sure I was going
No, it is. Yeah,
on a bit of a tangent there.
So I've brought up the thing that will get people confused is I brought up on the screen in front of us the Vanguard Global Aggregate Bond Index Hedged ETF, or VBND, which was what Roman Debt Collector was talking about. This ETF is approximately 70% US bonds, and this ETF has not done anything price wise over the past year. So it's basically like it's gone up and down a little bit, like fluctuated between negative 0.5% and positive 9%, right?
Yeah.
But that's probably not what you want it to. You don't want it to go up in a year where the stock market, the equivalent is the US stock market, like IVV went up 35 or 36%.
Yeah.
That's not what you want. You don't want that to happen. What you want is, as the US, or in this example, the US stock market continues to rise, you would just be happy for this position in your portfolio to pay you a little bit of income, which we call coupons.
Yeah.
Because you're knowing that it's not there to grow, it's there to provide a backstop if that other thing falls. And so let's say, I'm going to paint a scenario, it's not necessarily what I think, but let's say the US stock market bubbles along and something happens and there's a trigger event, US stock market plummets. What would happen, because the Federal Reserve sitting there thinking, oh gosh, all these people are struggling, the value of their assets, their properties, their businesses are going down, let's cut interest rates and try and stimulate money back into the economy. At that point, the value of your bonds would go up. I think that the second part, other than just not being sure why prices fluctuate day to day, I think a reason that people don't understand bonds that well is because it's not based on necessarily what happens. It can be based on what's expected to happen. It's kind of like share prices, where you have effectively, you have like the actual fundamental company profits and the sales and all that. But then the share price just does whatever it wants in the short term. It's kind of the similar thing with bonds. It's like it's based on expectations. If interest rates don't get cut at the next RBA meeting, for example, with the IAF ETF, which is an Australian bond ETF, you might see that bond get punished because everyone was expecting bonds to benefit from an RBA rate cut. But if the RBA comes out and says, no, we're not cutting rates for 2 years, then that ETF will be punished. But you'll still get your income in the meantime.
It's a challenge for most investors too. That you wouldn't expect rates to be falling while the economy and the share market are doing well. Not saying the economy is the share market. And it's incredibly, I've seen it for just ticked into 20 years now. When you've got different portions of your portfolio, we always look at the ones that aren't doing as well as the good ones. And equity markets have done so well that people, in my experience, your psychology just means you're less inclined to invest in those. Like if you're getting 1.5% or 3% income from a bond, but you've just seen your share portfolio go up 30% in the last 12 months, people want to tilt towards more into equities. But the key is you don't know when that crisis is going to come. And as Twin Chimps in a Trench Coat is saying, we obviously had a winner of the name this week. It's when that crisis comes that you've got something you can sell and deploy back into share markets at a discounted value. And that's what we call that rebalancing. And we have a framework around it. When your share market, when your allocation falls below 5%, below what we think it should be, or above 5%, and that tends to be what happens during these moments of crisis, that's when you need to be rebalancing. And that's where you go from the things that haven't fallen to the things that have.
There's the running yield on the VBND ETF, which is the global one I was just mentioning. The running yield is 3.34%. So that's kind of the current expected yield.
What's the distribution yield? This is the difficult.
Yeah.
This is where the detail comes in.
And the yield to maturity is the one that everyone talks about. That effectively represents not just the income, but also the capital component that would come back to the person that takes out the bond, like that owns the bond. So if a bond structure is that I promise to pay Drew back in the future, I'll pay you $100. You lend me $100 now, but I'll also pay you 3% a year. That's called a coupon payment. I'll pay you $3. But what happens is the bond adjusts daily to expectations and interest rates. And so the yield to maturity captures the repayment that I make to Drew, but also the final capital value that I'll return to him, that $100. And that's effectively how a bond is priced. But obviously in an ETF, you have thousands of bonds or hundreds at least. So it gets a little bit, so that's where they start using averages. And again, it gets confusing, but just remember yield to maturity is the one that everyone references. The running yield or the trailing yield gives you a better indication of the actual income that you'll get from that bond ETF or active fund. So there was another thing that we talked about briefly off air. I might just bring it up, is the idea of credit quality, which Roman Debt Collector brought up. Like, there's a lot of talk, Drew, in investment markets right now that there is a lot of debt going around. Like the central banks, obviously the governments have debt. I'm personally, I'm not worried about that. We spoke with Bill Mitchell, and we're just modern monetary theory fanboys, MNT over here. Fake money, right? But seriously, I kind of buy that theory, to be honest, that the government doesn't run out of money, but individuals can, and businesses can, like private credit.
Exactly.
A lot of these credit funds, these hybrid type things. What is your view on that?
Yeah, I mean, the question started as being around the US government, and there's always talk about, currency debasement, choosing a different currency as well, and then US government defaulting. And it might default, but it's not going to impact anything. Bill Mitchell will tell you that the government could print $1 trillion bill tomorrow. It wouldn't be inflationary. It's more where money is being allocated, similar to Australia. Too much is being allocated to too few sectors, so inflation is resulting. It doesn't concern me as particularly, and I don't see. I mean, rates are pretty high in the US still, so I don't see an additional risk premium for investing in US government. But there's definitely, and there's been a few good articles out at the moment. Some in Investor Strategy News, one of the publications we work with, and also in the Fin that's talking about private credit, and that's where a risk premium is payable, and risk premium becomes more important.
So what you're saying there is you're saying that if you invest in those things, you need to expect a higher return because there's more risk embedded in the actual investment.
Yeah, exactly. And you don't think that there aren't delinquencies. So I think it's interesting that the Australian banking sector basically only lends these days, or the big four banks only lends these days to the best loans possible, people that they know can repay or never be in arrears. It's the non-bank lenders and the private lenders that are taking up the rest of the market. And there have been, particularly in commercial parts, so hospitality industry, property development, a lot of these sectors, there's growing amounts of delinquencies or just inability to make repayments. So you need to be, it was, and this probably stems back to the period when interest rates were zero, when you were getting 5 or 6% from these significantly higher risk assets. Now you're back to getting 11 to 12, or you should be expecting 11, 12, 13, 14, 15% interest in private sectors, just for the reason that if these companies can't pay it back, you have to take control. You have to take the asset. Sometimes you have to finish the project. Sometimes you have to run the business. So I think, and this has always been the case, it's just even more acute now, that the sectors have become more popular. And it goes all the way from, you start at government bonds, you go to corporate bonds, you go to subordinated, then you go up to, private credit's still secured, but it's secured by different assets.
By a tractor.
Yeah, exactly. It could be anything. It could be consumer vehicle finance.
It could be a Toyota Hilux.
Yeah, that's always relevant, particularly in private markets.
It's interesting because one of the things in our community that I see, I don't know if you see this with your clients, Drew, is like a lot of people send me an email and they say something along like, "Oh, I could invest in this thing and it's promising 10% per annum." And I'm providing the mortgage for this person to finish their residential house. Like they're going to build this thing, like a construction loan. And I say, yeah, but what you haven't done is you haven't adjusted that income that you expect is going to come for the risk. And one of the easy ways to do that is to effectively look at what's the average default rate. Like you said, delinquencies, like what's the average default for that type of investment. And so say if it's like the average default is like 4% of loans, then you would go 10 minus 4 equals 6 is in theory where you might end up. If you're lucky, they might return 10, they might not, but you've got to adjust for the risk of your overall portfolio. And I think a lot of individual investors who venture into that market, even if you don't really get them in ETFs, but you do get them in managed funds, you've got to know what you're doing. Otherwise, just stick to cash, stick to term deposits, Stick to the big bond ETFs.
Yeah.
Don't stuff around with any of that stuff. Like even people tiptoeing into hybrids over the last few years is obviously the regulator said probably not a good idea anymore, guys. We're not going to let that happen past 2030, I think it is, or 2032. So, yeah, that's a bit of a red flag. Now we've got time for probably 2 more questions here, Drew. Probably the most topical comes from Global Excellence. I didn't actually see the name, but I get what they did there. The sponsor of the show, Global X, caught up with the team today, and actually we talked about you on the show that I recorded with them. So this is not planned at all. Yeah, we talked about you. I said, bloody Drew and his FANG call. This person's written in and said their name is Global Excellence. They've written in with, and they say in late 2022, Drew bought FANG. It's up 200% in the last 2 years since. So is now the time to sell? Drew, over to you.
Hodl.
So you're holding?
To be honest, it's in my super fund, and this is my investment horizon is hopefully at least 50 years, and you're talking about 10 of the best companies in the world, like hands down the best companies in the world. So I'm holding it. It's overweight, like it would probably represent 10 to 15% of my portfolio, but incredibly comfortable. Obviously, I didn't sell when everything tanked late 2023, and exactly for the same reason.
People in the past, Drew, like if you think about it, people in the past would think that you are very much adequately diversified. Before ETFs, if someone was like, I've got 15% of my portfolio in 10 stocks, that's 1.5 each.
Yeah.
That is completely diversified. It's only because it's wrapped up in one ticker symbol, FANG,
yeah,
and it sits in your brokerage account and you think, oh, it's a lot of money in one thing.
And the Mag 7's got a pretty high correlation to each other.
If one falls, they all fall. But like my point is that there are a lot of portfolio managers, like fund managers, that have 40% in the top 5 stocks.
Yeah, exactly.
That's concentrated. I'm not giving you personal advice on the podcast, but
4 stocks that take up the other 80%, but that's no.
I think I put it in my portfolio as well. My this is the best one portfolio. Did you?
Yeah, it was nice, and technically it's actively managed because it got rid of the Chinese tech companies and replaced it with some other American ones.
Which was a blessing.
Really good timing.
Yes. They also got rid of Twitter when that got sold.
I think I wrote a negative article about that at the time, but
how dare I sell this? The other questions that we have was a bit more from Lockie. It was a bit different. It's on superannuation. What are some of the best funds out there with low fees and high returns? What do you recommend for young people if they were to come to you? Are there super funds which invest solely in the American market? Because the Australian share market has been kind of bad the last decade. I would like to take something that this person has said and generalize it. Firstly is like, how do young people typically allocate in a super fund? But the second thing is I'm actually going to rebut a bit of this comment and say that the Australian share market has actually performed very well.
Of course you hit that one.
Because if you include dividends, the share market has been at an all-time high or near an all-time high for a very long time. It's just the people in the media that have you brainwashed into thinking that dividends don't count. And they record the XJO, which is the ASX 200, without any income. But if you add the income and then if you add the franking credits, the Australian stock market has performed excellently.
I think the problem is the accumulation index is reinvesting dividends, which isn't fair. Like it's an unfair comparison when you're comparing benchmarks.
Sure.
You want price plus dividends, but it's always price or reinvested.
Yep.
And everyone knows my view on reinvesting.
Yeah. You go for it.
Yeah, which question? Where do we start with this? I think you've probably heard we use passive and active in retirement portfolios because of the diversification benefits, but there is a comfort in your 20s and 30s probably in just relying on the index. So like the Rask Invest product, having more control, more focus on asset allocation. And you're going to be buying in every quarter, every month for the next 30 plus years. And in that, the thing is the majority of super funds are pretty competitive in terms of fees now. So you pay two types of fees. You pay an administration fee, which is you could pay it to a corporate super fund, you could pay it to an SMSF, or you could pay it to a industry fund, and that's anywhere from 0.1 to 0.2%. And then you pay investment fees, and the big fees are always investment fees. So Australian super charges from memory somewhere between 0.7 and 0.8, including its administration fee. But you could, from memory, you can buy Vanguard super fund, and the total fee would be under 0.2 or maybe under 0.3 for an index product and admin. You could invest into use something like net wealth from an advisor and invest into iShares and Vanguard product and get probably about the same cost. But that's just the index, and you're going to get the index return. You're going to have all the biases that come with concentration, government bonds, all those sort of things that are for another show. So there's so many options, and I think the big one would be SMSFs have a fixed cost as a minimum. So you're generally paying at least $3,000 to $5,000 a year just to complete the financial statements and tax return and audit that you need to do. That's the base you need to do. So on balances below $500,000 to $750,000, it isn't cost competitive compared to the others. Whereas the others, because they charge a percentage of assets, they become less competitive as you put more money in.
Yep. So I just looked up the numbers for the benefit of this question. Over the last 10 years, point to point, the Aussie market has returned.
You're still on the Aussie versus global.
9%. So fair enough. Someone that writes in would probably be thinking, well, the NASDAQ's done 20, it's a big difference. But if you just did price return, it's about 3.4%. So just don't be kind of hoodwinked by the media that reports that thing that doesn't show that it's doing much, but it is. You're right, Drew, in the way I think about the differences in constructing a portfolio for a young person. Over the years, we've had a lot of actuaries on the show, a lot of different types of really wonderful investors. And probably the really salient point that I take away from speaking with a lot of people who are dialed into the numbers is that if you understand that stock markets go up and down, and sometimes they go down for 2, 3, 4, 5 years before they come back, maybe 10 sometimes. If you understand that, you truly understand that, you should just be all growth.
Yeah.
It doesn't mean that you should be all US shares. Definitely. I think that's a risk actually right now. I think that you'd rather be all global than all US, but I think like a lot of US is fine, but not all of it, because there may be a decade that is not favorable. Like the biggest company in the world is Microsoft. That went nowhere for, was it 13 or 16 years? Its share price was still below its high.
Same as, the ASX took from, I think, 2007 until last year or the year before to hit a new, that's 17 years between all-time highs.
Yeah.
And I think the Nikkei, there's examples in every market.
The Nikkei was like 20 years or something more than that. So
no returns.
Yeah.
Point to point. But if you were, using asset allocation, invested in different sectors during that period, then you can turn out all right.
Yeah. So that's where the diversification is so vitally important. And people that don't like bonds or don't like this or don't like that, or you've got to have a bit of everything. It's not fun on the way up when the US is dominating and you think Australia's falling behind. You think, oh, why do I own that bloody thing? But really, after a period of time, it's happy days. So
the quick one where there was the first home super saver scheme, which was the other question, which you're allowed to draw a portion of your concessional contributions from superannuation to put towards a deposit. You can withdraw up to 15,000. Then this is voluntary contributions, not super guarantee. $15,000 in any 1 year or $50,000 across multiple years to pay for a deposit.
Yeah, so basically up to $50,000.
Can't buy a caravan or a houseboat, Owen.
Yeah, so basically for people that aren't aware, you can use your superannuation, you put money in and you can get money out. And the whole point is that you get this kind of what they call a deemed rate of return, which is effectively them saying you can put your money in your super fund and you'll probably get a better return, and after tax it makes more sense. There is a bit of rigmarole and you do actually need to buy a house, not a houseboat, Drew.
Yeah.
But if you're in a couple, it can be particularly effective because then it's potentially 100,000. So
dollar house, yeah.
Yeah. It's one of the strategies you can use to save more money for a first home. Probably the other thing is house sitting. That's probably a big one that's very popular in our community, is like go on Trusted House Sitters or Aussie House Sitters or one of these platforms and just house sit for people and try and save on rent. That's one thing. It's not always easy. There are a few different things you can do, but get in contact with your broker or advisor early because I'll be able to help with that. Drew, you do owe us a dad joke because last week when we were on the show, there was a bit of a patchy internet connection when you were recording from your jacuzzi. But I'll happily say that anyone who sent in a question this week, I will send you the Rask Value Investor Program for free. It's my full value investing training. You can get it on the Rask Education website. It's usually $499. There was one question we didn't read out about dollar cost averaging, which we'll get to next week. The Roman debt collector, Lockie, Global Excellence, 2 chimps in a trench coat, and I have no eyes. Right into us on the Rask websites. If you want to book care of Drew at wattlepartners.com.au. Drew, what's your dad joke for us this week?
Yeah, I was trying to find a better one, but I didn't quite manage to. I'm going to go with the base level here. Dad says to his son, "Nice shirt. Is that felt?" "No," says the son. Dad reaches over and touches it. "It is now." It's not going to work on the podcast, but I think it will on YouTube.
If you couldn't see it, Drew was touching his collar. Well, mate, that's good fun. For anyone that wants to get in contact, head to wattlepartners.com.au. There is a link in your YouTube or podcast player that says financial planning. You can click on that link and you'll get matched with a financial planner. So, Drew, heaps of fun, mate. See you next week.
It's good to see you.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing,